Welcome to Talk Tickers. Today, we're diving into Distribution Solutions Group's latest earnings report. Now, on the surface, the numbers looked pretty good, but the market's reaction was, well, let's just say it was all over the place. So we're going to break it all down and figure out what's really going on with this company.
Okay, so here's the headline that caused all the confusion. When the report dropped on July 31st, it was a classic mixed bag. On one side, you've got revenue coming in at over $502 million, a solid beat. But then you look at the official earnings, the GAAP EPS, and it's just 11 cents. That's a huge miss compared to the 21 cents everyone was expecting.
And this weird report led to a classic pop and fade for the stock. I mean, it shot up almost 4% on the day of the call, which is great. But then, poof, the very next day, it gave back pretty much all of those gains. So the big question we're trying to answer here is, why couldn't that strong revenue number keep the stock price up? What gives? To get to the bottom of that, we have to dig deeper than just those headline numbers. The real story, as it often is buried in the operational details. First off, let's just appreciate that top-line number again. $502.4 million in revenue. That's a really impressive 14.3% jump from last year. So, this isn't some tiny beat. It shows the business has some serious growth momentum right now. Second, and this is absolutely crucial to understanding the real picture, you have to look at the adjusted earnings, the non-GAAP number. That came in at a very healthy 35 cents. See, this number strips out all the one-time costs, like from their recent acquisitions, and it gives you a much cleaner look at how profitable the actual day-to-day business is. And it looks pretty good. And third, they generated over $33 million in cash from their operations. This is a fantastic sign. It means they aren't just making money on paper, they're bringing in real hard cash. And that's the cash they're going to use to grow the business and, eventually reward shareholders. But this right here is the hidden gem in this entire report. Take a look at the margins, specifically their adjusted EBITDA margins, which is a key way to measure profitability. Every single one of their business segments got more profitable from the first quarter to the second. That's huge. It means the progress isn't just coming from one hot division, it's happening across the entire company. So you're probably thinking, if the underlying business is this solid, what's holding the stock back? Well, to understand that, we have to look at what management is really focused on, their big consolidate and integrate strategy. So this strategy is all about growing by buying up other companies, what the industry calls bolt-on M&A. And you can see it's definitely working to boost sales. The 5 companies they bought in 2024 added almost $49 million in new sales this quarter alone. And this quote from the CEO, Brian King, is just brilliant. It gives you a real insight into how they think. See, they don't just see all the uncertainty around tariffs as a risk. They're actually using it as a commercial lever. It makes customers more dependent on them for their supply chains, which makes those customers stickier. Super smart. But, and this is a big but, that integration story isn't all smooth sailing. Management described it perfectly as a tale of two Canadas. Their old business out west, Bolt Supply, is killing it. Great margins. But the new company they bought in the east, Source Atlantic, is really struggling because of a softer economy out there. And it's dragging down the whole company's profitability. This right here, this is a big reason the market is so nervous. So that brings us to the bottom line. How do we balance that really strong growth against these very real integration risks? Let's get to our analysts' call on it. Going forward, we're watching 3 key things. First and foremost, can they fix the margin problem at Source Atlantic? That's number 1. Second, their TestEquity division has a brand new CEO. We need to see if he can get that part of the business growing faster. And finally, their whole story is built on buying companies. So we'll be watching the M&A pipeline to see if the growth can continue. And all of that brings us to our rating, Market Perform. Look, the company's top-line growth and the way they're running the business is really encouraging, no doubt. But for now, that's being balanced out by those integration risks and the margin issues we talked about. So we're taking a neutral but cautiously optimistic stance until we see some real progress on those catalysts. So the key question really is, can DSGR's integration machine fix these margin problems faster than the market expects? The answer to that is what's going to decide where the stock goes from here. And as always, a reminder, this is not financial advice.